Please welcome our first panel for today, Hiding in Plain Sight, Opportunities in Debt and Equity Heading into 2024, featuring Alan Litt, Al Goldstein, Rishi Gupta, and moderated by Yoni, Goodman.
That's smart.
Yeah, that one's like,
It's a really good announcement.
I got my sunglasses
Yeah.
over there.
Okay.
Yeah.
So welcome everyone to eCore. We have the distinction of being one of the first panels. We have a great panel here today. Three very good friends, very interesting people. We have real breadth on this panel. So we've got owners who own many thousands of units, lenders who have been in the business over the course of many cycles, and as you'll hear from Al, not only an owner and a lender, but also someone whose businesses require him to have a real macro view of the US economy generally. So the goal today is to be free-flowing and fluid and cover a lot of topics. But first, we should introduce ourselves. So I'm Yoni Goodman, the president of Meridian Capital Group. I think everyone in this room knows who Meridian is, but in case, we're a national intermediary. We're primarily a national mortgage intermediary covering every state across the country, across all asset types. Multifamily is always the closest to our heart. It's about 2/3 of our book, but we do all asset classes across the country, like I said. So it's a pleasure to host today. And Rishi, why don't you introduce yourself? We'll go down the line and then we'll get into some questions.
Cool. Yeah, Rishi Gupta. I'm one of the owners of eCore, and I run our investments business. Longtime Meridian borrower and client. eCore's an owner-operator of suburban multi in the Northeast and Mid-Atlantic. We're institutional in nature. We raise private equity funds that we own and operate, so we have discretionary equity. And we're looking to build a long-term portfolio that really is going to withstand the test of time and cycles. And so that's really sort of our central tenets.
Thanks, Rishi. Mr. Litt.
Alan Litt. I'm the president and CEO of Greystone, Monticello. We're a bridge lender, bridge to agency. Typically our loans are 2 to 3 years, and we're going from here to there. I also do whatever Yoni tells me to do, and that's a smart move if you're in this business. And we're out there actively lending every day.
Yeah. Hey guys, Al Goldstein, co-founder and CEO of Stoic. I guess I missed the memo on the dress attire today, but I'm like local, so it was just easier to drop off the kids and get here. But excited to be with you all. Stoic is a little bit different than what people here do, although we do play around the real estate world in that we own operating businesses. It's more of a holding company, but we are the second largest vacation rental manager now in the US. We bought 30 of those businesses over the last couple of years. We're the 5th largest appraisal company around residential, so obviously have a lot of ties into into real estate and the mortgage landscape. But in a prior life, which is where Yoni and I, Meridian and I really connected, we started buying distressed multi in 2009 and accumulated a portfolio of about 15,000 apartments across Chicago, Indianapolis, the Midwest, and the Mid-Atlantic regions, and subsequently have sold a lot of that portfolio. Some of our friends that we partnered with on the sale are in here. Our friend Moshe and Yankee at Emerald have been great partners, and with the help of Meridian, and also have a number of different touch points, including a bridge lending business. So different views around the whole category.
So Al, don't worry about the dress code. I usually there's an inverse relationship between dress and net worth, but we have Alan on the panel, so we broke the rule today. Okay, let's start with valuation. We're going to talk about values. We're going to talk about cap rates. We're going to talk about capital markets, and then we're going to talk about the U.S. economy generally, which really plays into all this. So, Rishi, let's start with you. So, multifamily values, it's on everyone's mind all the time. And I think what's unique about eCore today is you're actually buying real estate. You're buying multifamily in regular old arm's length transactions, not buying into the debt to get to the asset, et cetera. Right. So, I think the way to phrase the question is to get out of bed to do a deal today. There's a dearth of buyers in certain markets. To get out of bed to do a deal, you have to be seeing something. The cap rate, the price per unit. What gets you out of bed to do a deal today, and what type of attractive opportunities are you seeing?
Sure. First of all, thanks for having me on the panel. It's funny, when the news broke that we're going to be on the panel, everyone reached out to me. They said, how did you get on a panel with Alan Litt? How did you get on a panel with Al Goldstein? What was Yoni thinking when he put you on the panel? So it's nice to be up here with you guys. Being an investment manager right now is really difficult. And what we do is both easy and difficult, right? What we do is easy because we're buying brick, right? We're buying bricks and sticks, well-located stuff, providing necessity to everyone in America, which is housing, right? So that's easy. The difficult part is putting money to work, right? And we ask ourselves every day, why are we doing what we're doing? And I think that's really what, when you think about value, that's really where you have to start, right? What's Eagle Rock doing? We're trying to aggregate a portfolio of irreplaceable real estate in locations that we love, and we can own cycle in and cycle out. So then that's where we start, right, when we think about value. So a few things. One is values are down, obviously, right? Rates are up, values are down. Our pipeline's never been bigger, right? We have 20,000 units in our pipeline, so we can be selective. And it's fun, but at the same time, it's extraordinarily stressful, right? You can just ask my partner over there, Jim Hausman, if anyone has met him. I'm pretty sure his blood pressure right now is 180 over 120. So not a great place from that standpoint. But it's not for the faint of heart, but we're buying right now 3 properties, right? And what are we looking for when we're looking at assets? First of all, location. Location is key. If we can feel like we can own a location forever, that's a property that we're gonna look at. Then the next is pricing, right? Before we get to pricing, we say, is this a rent roll that's gonna be durable, right? Are these gonna be durable cash flows in the event that the prophecies that Al and Alan have of the future or the near and medium term future are gonna occur? Will we be able to continue to meet our debt service? Will we be able to continue to pay our bills? And will we be able to continue to deliver cash flow to our investors? And then we say, all right, well, what kind of return are we happy with, right? And for us, we look at it both on a levered and unlevered basis. So we're looking at total returns over a 5 to 10 year horizon. And our return threshold has widened out. You know, we're looking, instead of, call it a 13, 14 gross IRR, we're looking at anywhere from like a 14 to 17 gross IRR, so moderate returns.
Al, why don't you weigh in here? You've been a seller recently, but you're a very opportunistic person. We'll later in the panel, we'll get into your vacation rental business, which is very key into the U.S. economy, some of the key indicators in the U.S. economy. So you always have sort of a forward vision. But on values today and opportunity generally, are you a net seller, net buyer? And what are the different inputs that help you think about that?
Yeah, well, I mean, we talked about Pangea, which is the real estate business that we started in 2009, has been a net seller. We haven't really bought much since 2016. And part of that is, I think Al and I met for a few minutes before we talked about it. You know, I made the stupid joke that I'm kind of like the broken clock that predicts the recession that's coming every 2 years. And so we bought a ton of real estate starting in 2009, 10, 11, and probably got greedy. And so to a certain extent, couldn't deal with the market fundamentals in 2014, 15, and 16. In a way, got out of the market too early because the market obviously ran for a really long time. And Pangea's just been around for a long time. It was always built as a 10-year type vehicle. And so just natural state of the vehicle, we started selling down the portfolio in the beginning of last year. And so that's kind of naturally what we're doing. At Stoic Lane, we've been a very aggressive, active buyer of operating businesses, not actually real estate. But so, you know, my general framing, and we'll talk about this a little bit more, is I think we're in for a prolonged period of high inflation. And to me, that doesn't necessarily mean super high rates, because I think there are fundamental limitations on how high rates can be when we have 33 trillion plus of federal debt growing at 2.5 trillion a year in relative peacetime without a recession. So take that number to 50 trillion, not that this is exactly where we want to go. You can't really have 10% rates in this country like we had in the 70s and 80s. Just the math doesn't work. So I think we're in a period for high inflation rates. Physical assets tend to be great assets when you have high inflation. You just got to be able to hold on to them through those periods of fluctuation.
So that's a great segue. So Alan, you've spoken to me about the 3 roads. Al just spoke about timing and being able to hold on. The elephant in the room today amongst so many owners and lenders is there is a wall of debt that is maturing over the next few years, reflective of all the activity from 3, 4, 5, 6, 7 years ago. And that's really the elephant in the room. So many deals that are coming due today have very well-intentioned owners that are going through their business plans. How do you refinance debt today? That's what Meridian spends all of our day thinking about and doing. But on many deals, the proceeds are not available for a full cash neutral refi. How do you think about that?
So we're seeing banks pull back. The agencies, to a certain extent, are being a little bit more thoughtful about what they're doing. So you have $130 billion plus could go to $200 billion that has to go somewhere. And so what we are seeing that there's really like three roads. The road of pref equity, which, being frank, that means you're losing your property. It's a nice way to say you're losing your property because the pref equity guy probably is going to win that one out. The other way is we're seeing a lot of borrowers and we're seeing a lot of colleagues of mine in the industry talking. A lot of this was financed through a CLO. We're not in that position, but a lot of it people did. To keep it on a CLO, you have to have cash flow and you have to have an interest reserve. So a way to solve that problem is with a cap and an interest reserve, and you buy time. Why is time so important? If we listen to what Al said, he was right. In 07, 08, 09, everybody panicked. Al bought everything. Al made outsized returns because he bought everything when everybody was running to the door closed. If you have patience and if you have the discipline, if you're a great operator, like my colleague here, Eagle Rock, where you're thoughtful about it and you go sit with your lender and you are thoughtful about being the operator that you are, what this thing needs is time. And then the third option is you just hand the key in. And we're seeing that a lot on the agency side, and we're seeing that a lot on the bank side. If it's a non-recourse loan, certain operators have just, as they say, had enough. They're burnt out, they're out of cash, can't raise any more cash. So those are really your three paths today.
How do you access, as a buyer, how do you access that lender, when the lender takes that asset back? As a buyer, how is that going to really work through the system?
So what I'm seeing lenders do, we're not yet in that situation.
Alan, he's trying to build his pipeline over here. Just give him some advice.
Just curious, not for everybody else.
Yeah, what I'm seeing lenders do is, Yoni knows, and Yoni and I have a very close relationship. He knows our company focuses on one thing, and Yoni and I talk about this at length, is the operator. Who's owning the asset? Who's there doing the work every day? Who's the guy, like you said, who's thoughtful about what he's acquiring? Those are the guys that you go to who you know are good, and you figure out something with them. It might be that the bank ends up being the capital, so that there's a relationship there of capital to operator. Banks don't want to operate assets. They really don't. But they have to align themselves with thoughtful, creative people. And that's how you access that product, is creating those long-standing, durable relationships or introducing yourself to a lender because they might not know that you exist. That's what you call Yoni. Yoni, get me to this person, get me to that. He knows everybody.
He does.
Okay? So the question becomes, for you, is to get to that, you got to get to the lender. You got to get the lender comfortable that you've been able to execute. And even if you haven't, and you've had your own problems, it's always good to just be honest about it. And then that's where I think that relationship occurs.
So Alan, I don't think most people in this room would consider it a positive to take pref that really means that they're losing their property or to give back keys. But then again, the third road of capital calls always require very disciplined analysis. And Al always preaches this to me, both when he's wearing his lender hat and owner hat. So much of real estate is timing. You have to be able to hold on. And so when you borrow money, you can't borrow on how you feel today. You have to be able to hold on. In order to make that assessment of the third road, is it worth the capital call? And I think a lot of people in this room are making that assessment right now. What are the key inputs? How does one think about that? And I'll open it up to the floor.
Al said it. Al said it a few minutes ago. In a rising, he's 100% correct.
I'm trying to remember what I said.
No, you were correct. You were correct. You should have been an economist.
Prescient, actually.
No, you should have been an economist. In a rising inflation, hard assets are the best thing to invest in.
Well, to that point, I mean, in history, to me, is really, really interesting. I don't know how many people here have read Ray Dalio's books, and maybe that's why we're aligned in our vision of falling empires. But the Weimar Republic before World War II in Germany, terrible time in history, obviously, for a lot of people in this room. That massive inflation, equity markets soared in Germany, right? Equity markets, asset markets appreciate with inflation. In Argentina, which has basically been bankrupt forever, you have massive inflation, 100% inflation. The equity markets are up 20 times, right? Real estate as an equity-linked asset. Especially, I think office in cities that are broken is a different story, completely, because you just can't get the cash flow. But if you have multifamily assets with a massive mismatch of supply and lots of households that need to be built, there's going to be cash flow. So it's just a function of, like the leverage line. I don't know if you've heard this line. I love the Charlie Munger line. I don't know if people have heard it, but there are the three L's that will take you down: liquor, ladies, and leverage. And so, hence, if you are equitized enough and you can maintain your assets through a period of economic volatility, I think long term you do really, really well with these kind of assets.
So,
But a lot of times it depends on like what price you're actually in on.
let's
right?
let's talk about that, because again, you own a great asset. You have a certain debt level. You have a certain view of value. Your view of value is your view. Other people could take a different view, and that value is going to change over time. That So how do you make this assessment? I think you're about to touch on that.
Yeah, look, the basis, people say, well, I got in at a great basis. This is a great basis to buy this property. Well, you know what? Basis doesn't buy bills, right? We're focused a lot on who the renter is and where you can actually push rate to. And I think the consumer is very stressed right now. So when people are saying, you know what, we're just going to get some pref equity or we're going to figure out some gap equity, I'm like, to what end, right? Like, what are you really trying to solve for here? And I don't think a lot of these borrowers who bought over the last 2-3 years and put on some of that high leverage, even if they got that gap equity, I don't know if they can inflate out of the value.
I mean, it's going to take a lot of time, no question.
And how do you hold on? Like, so let's say they come in with pref equity. What are they doing to actually the debt stack?
So the guy who's coming in with the pref equity is automatically conflicted because he's typically not the guy who put up the majority of the money. So the guy who put up the majority of the money is not in the room typically. It's the promoter, it's the syndicator who walks in, says, now I have pref equity. He's just protecting himself. There's a complete conflict there very often where the person who's coming in with that pref equity realizes that he had a business plan, I got to just get time. And so you just got to, do you believe in the operator? Do you believe in the market? It's a lot of work. You almost have to re-underwrite the whole situation again.
But are they able to right now? I mean, for us, we have some very long-standing relationships with our lenders, and so we can still get that 5, 7, 10-year fixed rate debt. But for people who have the debt maturities coming up over the next couple of years, how are they working through? Yes, they pull in the pref equity to make up the deficiency in their DSCR or their leverage, but how are they extending out their mortgages, the primary mortgages?
So we're seeing a lot of fixed rate product going away from us. We're a floating rate lender. Yeah. We're still off our books, $1 billion, $1.3 billion, $1.6 billion a year. We do $3 billion a year in originations. Like it's just going. It's just every year it just keeps turning and turning and turning.
And because Rishi and I are reversing roles over here, I'm going to answer the question, which is, and it's a good segue to our next topic, which is liquidity. Just so everyone's clear, there's a robust lending market for multifamily and CRE across America today. You have the agencies, you have banks, you have funds, you have life companies. Everyone wants to put out money. The issue is last dollar proceeds. Everyone wants to put out money, and frankly, the money is priced very reasonably. The issue is last dollar proceeds. So I think to answer your question, it's not a problem to get a senior loan. The issue is what's the attachment point? How much of a senior loan can you get to reduce that pref? Because the pref is painful. But I would just tell you, and all of Meridian's clients in the room here know this, the market for the senior loans is wide open, and you have to be deliberate about what end of the curve you're pricing over. Part of the flight from Alan's segment of the market over the last year was it was just very painful to price over 5.25 LIBOR or SOFR, particularly when the other end of the curve, when the long end of the curve was so much lower. Now you've seen that flatten, and I think a lot of the market's going to come back to Alan. But you touched on liquidity, and pref is a form of liquidity. Our founder and CEO, Ralph, who needs no introduction, always says, if you watch a day in his life over the past couple of years, and you watch the phone calls that we take all day, you would think that we're schizophrenic. We're telling one person who calls us in the morning one thing and another person in the afternoon another thing, and the advice is all right. But part of that sort of dual message is that the liquidity situation in multifamily, for example, is a tale of two cities. You have, in the morning I could be telling someone the world is awash in liquidity. The number of phone calls we get at Meridian from funds, from new funds in the space who have raised billions of dollars. New funds in the space and funds that people know. So the Monticellos and the MF1s, just raising billions and billions of dollars, right? And frankly, all the new entrants into the market. So you feel, wow, the world's awash in liquidity. And it's priced in a certain place, but it's awash in liquidity. You then spend your afternoon talking to folks that are agonizing over capital calls and talking to the senior part of the debt stack. And you say, wow, there's a dearth of liquidity in the market. So let's talk about liquidity. Alan.
So, two things. One, the reason why you're saying that is because you and Ralph, just so everybody knows, Ralph paid extra to sit in the front row of our panel today. He scalped tickets for the front row. So, but think about it. People come to you because you are getting all of those calls. That's why they're coming to you. You're seeing all of us. You're seeing all of them. They're all headed not necessarily always to you, to your team, to Ralph, to others. They're calling you for that insight as to exactly what we're thinking and how they're developing their business plans. They could probably go on their own and do it, but they're not going to have that tremendous breadth of information.
Liquidity. Talk about it.
You know, we're seeing there's a lot of lenders, there's a lot of buyers out there. Everyone's looking. But the challenge is no one has conviction, right? No one has conviction on value. No one wants to catch a falling knife. In terms of values, do we think that deals are going to be trading market large at 7.5 caps in our markets? We don't, right? We haven't seen those when rates were where they are now. We haven't seen them when they were higher. We just don't believe that's where things are going to trade. Yes, there's going to be one-off opportunities, but we think that where our markets should trade should be anywhere between, call it a mid-5 to like a mid-6, right? Cycle in and cycle out. But the challenge is that a lot of the liquidity isn't willing to put money out at those values given where rates are today, right? So I think there's a flush with liquidity, but people they're not certain where value should be. Like, I don't know if you have a perspective, Al, in terms of where you think you would be a buyer right now, because I think you're trying to get back in the market, given your view of high inflation.
Well, again, I don't think I'm a great proxy for it because I was the one not buying in 2015 and 16 because I thought cap rates were too high. Yeah. You know, or too low, rather, for our target. So we missed a window of great returns because of that, but that's just not the business plan I've ever had. It's always been very opportunistic. But I can tell you, on a separate point, if anybody here feels bad about kind of the state of the real estate market, spend an hour in a room like this with tech venture investors. You'll feel great, you know, because that's, you know, where I've spent probably half my career outside of real estate. And there you have fundamentally the same issue, way too much capital into venture-backed company startups over the last 5, 7, 8, 10 years. Not a lot of companies have failed. And ultimately that is all being digested as we speak. At the same time, on the other side of it, I think there's lots of opportunity. And so I'm not a buyer at a 6 cap.
But where would you be a buyer? Like, what would your returns have to look like?
Again, like the capital I've always been able to raise, and I'm in the process of raising capital. So I'm spending all my time buying operating businesses, like I said. Yeah. I'm buying operating businesses at 5 times cash flow. So that's sort of like my proxy in my head. So they're not real estate assets. I can't finance them as attractively as I can finance multifamily, but I'm getting a 20% cash yield. So if I'm buying them at 5 times and I can finance at 3 times cash flow, I can generate a 25 or 30% return.
But real estate's a hard asset. It's a different beast. What cap rate, where do you start to get interested?
For me, it's probably 8 and higher. But again, there's a reason I'm not the right buyer for today's market.
Al always says Al predicted 8 out of the last 2 recessions. So, you know, he's you know, that's his mentality.
But again, I talk out of both sides of my mouth. I'm not that I'm a politician, I guess, but I think we're in for a challenging period in the U.S. economy, no matter what. And I spend a lot of time in consumer credit. We have a business where we have 2 million consumer borrowers that are subprime, near prime across unsecured loans and credit cards. We see that. You're seeing that with the banks. The consumer in the U.S. is stretched, and they're hitting a wall as we speak. At the same time, on the other side of this, I think there's going to be a great opportunity to own these physical assets. So to me, I don't know what that point where it flips is going to be. You know, it's probably not where I would be a buyer. It's probably below that because there's a lot of liquidity in the market. But you know, there's definitely a point probably north of a 6 cap.
Yeah. I mean, I think right now, when we're financed, we're doing we're buying 3 deals right now. 2 of them are loan assumptions. 1 of them is a new loan. and we're buying between a 5.5 and a 6.2 cap, right? And it feels pretty good because the deal works, right? The deal works with our underwriting, which is conservative, and the deal works with leverage that we can get. But do you think also you're going to get 8 caps, Alan? Because if you're thinking you're going to get 8 caps, then...
Well, I would say it's market specific. Like if you're in Miami, just we're sitting here, and you have great growth and phenomenal demographics, that's probably a great deal, right? If you're in Chicago, when you're bleeding population and you got all sorts of demographic issues, maybe not.
Maybe it looks good.
Yeah, and look, Al, I think in the areas you've invested, and Al's being modest, he owns thousands of multifamily units. In the areas you've invested, they generally do correlate to that sort of, historically, to that population flight. And so I think that orients your view of cap rates. For someone to pay, as Rishi and Jimmy, they're pretty smart guys. And for someone to pay, anywhere from 5.5 to a 6.5 cap when you have the opportunity to invest in 10-year treasuries at 4.5, you have to have conviction about rent growth. So let's talk a little bit about rent growth. Let's talk about the backdrop of the U.S. economy. While consumers are stretched, you clearly have the view that in the markets you're investing, the fundamentals are going to allow you to hit your return. So let's talk about that.
Yeah, we are focused on economics 101, supply and demand, right? And in our markets, we're extraordinarily supply constrained. We're rich in terms of economic opportunities for our renters, and renters don't really have great options, right? And a lot of times the assets that we're buying, they're just not operated as well. There's not as good of a product provided to them from the prior ownership. And so we're saying, listen, if you're in a location where people want to live, where there's great schools, great access to jobs and retail, et cetera, and you're buying it at a yield that you can live with, and you can provide a better product for them, and you're not worried about new entrants from new developments, that's a deal that we want to buy. And so that's really where we're focused. We're focused on the rent-to-income ratios. We're worried about our stressed consumer. I'm curious what kind of stats you're seeing right now on that consumer. But I think generally that's what gets us going, right? I think a lot of times those growth markets, what we're concerned about is just supply coming in, right? We have 1 million plus units being delivered over the next year or two, and we have more that's right behind it coming up. And so we're concerned, we just don't like that sort of boom and bust type locations.
Right. Alan, let's talk about the floating rate loan universe. The competitive landscape, there have been a lot of funds raised. Not all lenders are the same. You have permanent capital floating rate lenders like the mortgage REITs. You have people in the fund format. What do you see as the competitive landscape in the floating rate market? We see it to be a fairly liquid and competitive space. And then when you look at opportunities, you have a lot of stuff hit your desk. We talk, and I know you sort of have your pick of the litter in terms of the opportunities you're seeing. For this room, which has a lot of borrowers, what is an attractive loan opportunity for you? What's an attractive borrower for you? What sort of separates a deal from the pile?
So right now we've been given direction from our board to focus on the operator. We're in good markets. We're in supply-constrained markets. We feel comfortable. But we had a big board meeting a couple weeks ago, and it's now like over a month ago, and our board basically came back and said, we want you to redouble your effort on the operator. Forget about 25 basis points this way, return that way, half a point this way, half a point that way. The reason why is it goes to exactly what you were talking about is if we stick with the better borrowers in this market, we're going to get through the market. Borrowers who are new, who are undercapitalized, we're looking at liquidity, we're looking at net worth, we're looking at REO schedules, these kinds of things, what that borrower has to go through over the next 2 to 3 years, that's our focus. And there's 1 million lenders who could lend at 300 or 3.25 over. Some like us, some don't. But our focus has been, because we have a very big funnel of opportunities, is focus on the better borrowers in the better markets.
So we'll get to Rishi's view of sort of fixed versus floating rate debt and how you manage your portfolio. But Alan, I want to stick on something you just said, because I think part of the point of these panels is not just for us to sit up here and talk, but to actually add value to the room. And we talk about this a lot. You always say that there's very little such thing as bad real estate. You have some bad timing, exactly. and then sometimes you have borrowers that might approach a situation not the right way. And you always say, just pick up the phone and be transparent with us and be honest with us and talk to us. So give this room advice. Everyone's got questions for their lenders. Everyone has wants and needs, and my cap strike price requirement is here. Can it be a little bit higher? Can you defer this or that? Can you waive a fee? How should borrowers approach that, right? Because there's a mentality that I'm the borrower, I have this request, and then you're the lender. Some people feel like it's about who has more leverage and who can outsmart who. I think you have a little bit of a different view and a fundamental view on how borrowers should approach lenders. What is that view?
So the view is,
what's the advice?
The view is to get in your car, get on your plane, get to the office. Come see us and explain what the situation is, and don't send a bunch of kids. The grown-ups have to be in the room. Whoever the owner is, whoever the person with the property manager, whatever the situation is, give us the best information. And we, over the last 18 months, have helped so many people that basically just came in and explained the situation, not through a broker or a third party or intermediary at the company. The owner came. And it is a huge difference when my partner Tom and I sit there with our team listening to the person who's actually suffering. Some of you guys are suffering through some tough situations. The lender is actually sympathetic. It's very simple. Just tell me what the problem is and make sure I'm the first one to know. We do a lot of lending also in healthcare. So when something goes wrong in a building, just make sure we know before Google does. And so the reality is we have so many borrowers that think that hiding from the issue, it'll go away. It actually gets worse. Just come in, hear the numbers, here's what you have to do, here's what I have to do. And so far, I think we're like 99 out of 100, that it sort of works for everybody because we don't want the assets back. That's not the business we're in. And you don't want to give the assets up. So let's figure out something, but face to face, not through text, WhatsApp, or whatever.
So Rishi, we spend a lot of time with you and your team. Yeah. And I don't know if Abe Hirsch is in the room. Abe spends a lot of time with you and your team talking about how you think about debt. You have someone with your reputation, select sponsor, know everybody in the business. You guys have your choice of lenders. You have your choice of how you ladder your maturities, fixed, floating. Talk about how you think about that and how you think the room should be thinking about that.
Our investors never want us to be take views on financial markets, right? They want us to buy great real estate and operate it really well. And so they don't want us to take that floating rate debt, right? They want us to match it up with the business plan, but they don't want us to take outsized risks. So we've always been long-term fixed rate borrowers, 5, 7, 10 years. We want our maturities to roll. We have one loan maturing next year and a couple of loans maturing in 2025. Because we always felt like if the deal works on the underwriting with a long-term fixed rate loan, that's a deal we want to buy. We want to deliver cash flow. We want to deliver long-term returns. I do think there's going to be an opportunity, if you want a little silver lining here, with a high inflationary environment for a protracted period of time. I do think there's going to be an opportunity to refinance some loans coming up over the next 6 months. Because I think you're seeing some of those inflation numbers crack, right? And I think that's going to happen and continue to evolve, especially as the reduced cost of housing comes into those inflation numbers over the course of the next 3 to 6 months. So I think in this first and second quarter of next year, I think you actually might have an opportunity to fix some of those loans that you may be concerned about.
Right.
And that's what we're looking at.
Yoni, we are seeing over the last 30 days a tremendous number of our borrowers calling up, looking to move toward the agencies or some sort of bank fixed rate product. Help us get, that's the other thing as a bridge lender. Borrowers come and say, help us get there. What do we need to do? It's amazing how they're using us now as a sounding board or resource. Just, what do you think? What should my numbers look like? Explain to me how I should be presenting it to the permanent lender or whatever. And over literally the last 30, 45 days, on fire with the number of calls we're getting with people looking to rotate out of our book.
Would you ever offer long-term debt yourself?
No. Yeah. Look, we're in the moving business. I'm in the moving business. I'm not in the storage business.
Look, I think Alan. There's obviously a deeper level to that question, which I think Alan isn't saying explicitly, but Alan is well aware also of, when you're a fixed or floating rate lender, it's all about cost of capital. And Alan knows that there are depository institutions, institutions that are on the life company side looking to match assets and liabilities that he can't compete with. And so, would he want to be a fixed rate lender? We talk about it. Sure, he'd want to be a fixed rate lender. Give him a zero cost of capital. He'll be a fixed rate lender. But I think to touch on that a little bit more, we at Meridian are seeing the exact window that Alan's talking about. Yep. So we have taken this opportunity as rates have come down to really take advantage of that, lock in at this treasury. One thing our clients have learned with us the hard way over the last couple of years is that every time there's a dip and you think it's moving in one direction, something surprises us. Lord knows in today's world, there are surprises around every corner. And so I think a lot of people are availing themselves of this dip. But the other thing that we're seeing, and it's a big trend in the market, is all of the alternative managers like the Apollos and the KKRs and so many others that we do a lot of business with that have raised these separate accounts, life company separate accounts. Those are very competitive long-term fixed rate options. Yeah. And depending on how the agencies feel in a given week, they can be very competitive with them. And so we've seen our clients jump into this window, but also really start taking advantage much more of those alternative sources of capital. And it would, they're interesting because they're fixed rate. They can be, 7, 10 year. They can have more, flexible prepayment structures, and they're just another source of liquidity. So I think that's interesting. I want to come.
And that's what we're constantly looking at, right? We're constantly evaluating our portfolio, and you have to position your portfolio for a refinance to take advantage of a gap down in your rates. There's so many of my friends and colleagues who are like, oh, rates are down, now I'm going to look for a refi. I'm like, you're going to miss the window. Right? You have to constantly be in that conversation, right? Yeah. To be able to take advantage of it.
You have to be in the conversation, you have to be teed up and ready to go.
Right.
And then you can sort of play the game a little bit. But you can't decide to look into it, in a week like this. You need to have gone there. So Al, I want to come back to you for all your fake bearishness. You're buying a lot of real estate and businesses. And in particular, you have a vacation rental business that's pertinent to this room because it speaks to the American consumer, their ability to spend some money on a discretionary basis. You're buying appraisal businesses, and you do, because of your Avant credit business, you've got a sort of inside view into a lot of Americans' pocketbooks. Let's talk about where you see the opportunities. And this room is a very entrepreneurial room. They own a lot of real estate. They own other operating businesses. I think the reason Alan is so focused on sponsor is that a lot of his roots are in very heavy operating businesses, like some of the healthcare stuff where, the operator matters. You're not just collecting rents in that business. You're not just collecting rents in multi either, but certainly in skilled nursing, you need to be a real operator. Al, let's talk about the opportunity, because again, for all of the recession predictions, you have found ways to allocate capital, and you've done so with a very long-term view of investing. So let's talk about that a little bit. Some knowledge you can impart in the room on your view of the investing horizon, where you do see opportunities across
all the wisdom.
Let's talk about that.
Exude. So I guess going back to, I think Rishi asked a question, what you're seeing on the consumer, which I never answered. So this is, in my other life, we have a big credit card business to subprime borrowers, and I don't know if people here follow data coming out from the banks. Actually all the banks reported in the last week, and pretty much everyone has seen credit losses double in the past 12 months on credit card in prime consumer. It started with, in our world of near prime consumer, which basically is people that make between, call it $40 and $90,000 a year. $80,000-$90,000 a year doesn't feel like it's as much as it once was. I think we all know, part of the inflationary pressure. And I can come back to my view on inflation as well, is, consumers are hitting a wall. All the credit card originators, lenders are, us included, we've been doing this for longer because our consumers are subprime, near prime, are starting to cut lines. They're starting to be much more conservative as to what they're lending. The banks are doing this in mass now. And what's happening is the debt was really the last dollar for a lot of consumers. Right, we were levering up. Restaurants are all still full. We're still in rent pressure, but I think there's a massive lag to all that kind of stuff. And so we're 6 to 12 months away from seeing that pressure in the U.S. consumer. We're growing as an economy, and this is going deep down the rabbit hole because we're running a $2 trillion federal deficit that's going to $3 trillion. And look at that on GDP terms. $2 trillion is 10% of GDP. So think about it in terms of growth. So that's a challenge, no question about it. We're seeing that pressure in our vacation rental business, RevPAR, which, I don't know, I'm sure there are a lot of hotel people here. RevPAR is down across the vacation rental industry, anywhere from 10 to 15% off COVID highs. Probably going to be flat to down next year as well. We see opportunity because we're buying small companies at very attractive prices and multiples and putting them together into larger national platforms. So you get multiple arbitrage, you get scale benefits, and then if you have a 10, 15-year view, you're going to create tremendous value, right? Would I be buying, top tick kind of markets based on the assumption that I'm going to grow at 5 or 10% next year? Probably not. I don't think that's where we're going to be, and that's true in hospitality. I think appraisal is a total mess today because mortgage volumes are down. As we know, there's no refi volume. Purchase volume down 50%.
Resi mortgage volume.
Resi mortgage volume. Yeah, that's our appraisal business is residential, so I should clarify that. Purchase volume is very low for a couple of reasons. Obviously, rates are really high, north of 8%, and at the same time, there's no inventory because who wants to sell? People are locked into 2.5% mortgages. You don't have the maturity issue that you have in commercial here because basically everyone that could refinance over the last 3 or 5 years did, and they have these 30-year fixed rate mortgages. I think 97% of mortgages in the US are 30-year fixed rate. And so you have a fundamentally different issue there. Our business is definitely challenged, but we're building technology to supplement the appraisal process to ultimately create lots of value. So I still think there's tons of opportunity, but you have to be very, very selective about it. And in 2009, I don't know if you guys had this experience, 2009, 2010, I was raising capital to invest in distressed real estate. It was really freaking hard.
To raise the money.
Intimidating, incredibly hard, intimidating. I was growing my beard out to look like I was a little bit older and more mature, which I'm still not. But it was very, very hard. At the same time, to me, it was a screaming time to invest in real estate. And I think it feels a lot like the same. I think we're a little bit early, but I'm raising capital for Stoic Lane. It's hard. Investors are challenged with back books and portfolios. But if you ultimately find the right capital base in the next 3 to 5 years, I think there's going to be tons of opportunity to create value.
Yeah, and I think that's the message. Rishi, you should tag on to that because, again, with the ability to do nothing, you're doing stuff. So let's talk about that, and then we'll cap off.
Yeah, you can't call a bottom, right? Just like you can't call a top. So our view is you got to be selective, you got to find the right opportunities, but you got to continue buying, right? If you're going to continue to wait, that opportunity may not come, in our opinion, because there is so much capital out there that might just add this floor, right? You may want to buy at an 8 cap, but there may be plenty of people that are willing to buy at a 7.5. They might get gapped out of the market because there's plenty of people that are willing to buy at a 7. Right. So our viewpoint is you got to focus on the real estate. If it's great real estate and you can finance it well for a long duration to get you through the storm, you may have an opportunity to refinance down the line, and if not, you'll just be able to hit your returns.
So I have a tradition. Go ahead, Alan.
You keep saying the same thing. It's exactly what, as a lender, I keep wanting to hear. Focus, focus, focus. Those that are focused are going to be fine. Those that are trying to catch a falling knife or a rainbow or something, those are the tourists, we call them. We call them the tourists.
And Alan, you don't like tourists.
I don't like tourists. And
awesome.
It's not like you have to have a borrower who has a long beard, but you have to have a borrower who says exactly what you just said. Focus, just focus on that.
So look, instead of thanking the panelists, my tradition is to make a plug and to inherently thank them for taking their time. So for those who haven't realized that Al is, one of the smartest guys in the room. He has a lot of capital to buy all things from real estate to operating assets. He will be around. He'll be around at this conference. Alan is one of the smartest floating rate lenders and just knowledgeable people on how to navigate through a lot of situations in today's market that you will ever find. Naturally, you can't speak to him without speaking to Meridian, so we just have to get that out of the way. But and then Rishi, I think the big takeaway is Eagle Rock is buying. They're opportunistic, they're buying, and they can solve problems for a lot of people. So I want to thank the panelists, and we'll go on to the next panel.
Thank you.